2014. My name is Nenad, and today I will be your host. I will show you how you can trade on high volatility. If you remember our last webinar, we had low volatility trading, and today we will speak a little bit about high volatility trading, why high volatility trading can be successful, and of course, I will show you a few tricks. I don't know if any of other traders, teachers, or mentors do that, but this is one of the tricks I personally do when I spot that there is a high volatility. Just before we begin, of course, standard risk disclaimer. So risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. So today, before we begin, of course, I will just, because I'm not sure that how much you know me, I will tell you a few things about myself, because when everything I do it transparently. I don't have anything to hide, and that is the way how I teach, how I trade, and that is the way that I'm always willing to show my real account statement of all accounts to all of my potential clients, potential students, and everyone, of course, considering this job. And I know that many traders just do not show you real account statements, which is, for me, that is a normal thing. We always need to be very transparent and always need to be very clear about what we do, because that way we can build trust between us, between market, and generally between potential business clients. So I have been a full-time trader since the year of 2008. I've been running a thread, namely Spider's Den on Forex Factory, and my nickname is Tarantula. That is a known nickname in this world of Forex trading. And basically, I've been trading full-time since 2008 and 2010. I've been trading also on institutional accounts. I also manage many other forums and blogs, such as Worldwide Investment blogs, Admiral Markets blog, and I'm also writing for Forex Trading. You probably know my analysis, my predictions, and I've been constantly doing lecturing and analysis on Admiral Markets website and also on Admiral Markets webinars. I'm also the creator of a proprietary price action method called Camarilla MACD, and Camarilla MACD is my personal style. It's a price action method which I have been using for analysis and for trading both retail and institutional accounts. I always do pre-fact and real-time analysis. That is how I work. I never write about what happened after, because people and mostly traders are interested in correct information, what can happen and what could happen, and particularly what happened after the price made some movement. That is, in my opinion, that is not particularly interesting, because you can do it yourself. But many traders, even some experienced traders, everyone needs help in Forex trading, because it is a common thing and it is a well-known truth that only 95% of traders are actually making money in Forex market. So the thing is, always, and that will stay as far as I am in concern, I will be always giving a pre-fact and real-time analysis. So I don't know if you have witnessed to my trading advices or not, but usually I do on Mondays I do session recaps. I also write intraday analysis for Forex Trade, and most of the time all of those entries have been successful. Also, as I said, my results are transparent for full Forex education for people who want to follow me and who want insight in Camarilla MACD and how I do. I'm always willing to show my real account statement, and that is the thing which I am proud of. So, this is in short about me, and now let's move on to our main subject. I will teach you how you can trade during high volatility. It's actually a nice trick which you can apply to your trading. It does not use any indicators, and you don't have to use any indicators, but the ultimate indicator, which is price action. As if you were following me and you're following me maybe my work, you probably know that I am a follower of price action. So I'm not particularly interested in any indicators except the MACD, which is always present on my chart. And there is one purpose where I use MACD, it's finding divergence, which I use for counter trend trading. So actually, when I do counter trend trading, that is why I always look for confluence. I always look for potential price rejections, important levels. And during my trading career, I have known, and I'm 100% sure that price action repeats itself. That is why I'm extensively looking to find historical buyers and sellers across the chart. I've been trading 25 pairs, so for me, euro dollar is the same as Swiss yen or GBP New Zealand. I just don't make a difference between pairs. There are also many other important things such as correlations and so on, but I think that we will have, from now on, 2 webinars per month. So I'm actually encouraging you to come and visit, because I will talk extensively about other aspects of trading which are very useful if you trade more than 1 or 2 pairs. And I will be showing you always some neat tricks and behind my sleeves which I do for trading. About volatility, I need to say just a few things before we begin. And this is what I'm insisting when I do Forex teaching and mentoring. This is what I'm insisting to do always. Successful trading is always based on a tripod. That tripod is a profitable trading strategy, risk management, and trading psychology. If one leg falls, everything will crumble. So actually, this is the tripod of successful trading, guys. Remember this, because I'm insisting on this. This is the most important first step in your trading careers. It's not the chart, it's not the system. The very first step in your trading career should be a complete understanding and knowledge of tripod of successful trading. A profitable trading strategy, risk management, and trading psychology. Those 3 things make up for a confluence. This is a confluence of a successful trading career. If one leg falls, everything will crumble. We can also add the element of volatility. We can try to trade on low volatility. I also showed you how to do that. But to be honest, it's better to have a normal or high volatility than to have a low volatility. This is my last webinar before I go to holiday. And actually, I will be having a holiday till 18th of August. And that is done on purpose. I have picked up the beginning of August just because there is a lack of volatility during the first half of August. And that is normal, guys. Many banks will not work. Smart money will not flow through the markets. Big retail, big institutional traders, pension funds, all those uh, participants for big money in Forex are mostly on a quote vacation. So actually, if we want to trade successfully, we need to follow big money. We can do that if we have volatility high, or which is the best, normal volatility. And before you consider trading, you need to set up 3 tasks. Primary task is not to lose a capital and stay on the flow for many years. The second task is gradually multiply your equity figures. And the third task is earn profits. Problem is that most people set a third task for the first place. So success comes down to proper risk management. Okay? You need to know when to trade. You need to know the market you will be trading, and you need to know when not to trade. That is very important. Not every day is a day for trading. Now, I already told you that we need volatility in Forex market. Now, Forex market is not a centralized market. Forex market does not use volume in trading. We can talk about tick volume if we generally talk about volume, but because there is no central stock exchange such as stock market, we actually we look through a prism of volatility. When there is volatility, if we know what we are doing, we usually have success in trading. If there is no volatility, we still can trade or try to trade, but our targets are lowered, our stop losses are also lowered, mostly the price will range. So it usually will come to some sort of range trading. I already talked about it. So when there is high volatility, it's actually easier to trade when there is no volatility or very low volatility. And the best definition of volatility is how that represents how much a price fluctuates over a period of time. So actually, volatility is a price fluctuation over a period of time. I can also describe you, let's say that if you see the price action like this, you just need to watch the price action. If you can see that the price is actually going sideways, we can say that there is a low volatility and there is no, we usually stay out of it. If we want to trade, we can try to trade by low volatility system, low volatility method, which I showed you. But actually, I personally prefer normal, or at least if there is no normal volatility, I'm also able to trade high volatility. So high volatility is when there is big change in price over a short period of time. And we can easily spot that, guys. Usually, high volatility will happen after a period of consolidation, let's say a consolidation triangle, and when price is getting close to a pinnacle vortex of this triangle, usually it will break up, collecting some stops. First, we have stop collecting or stop grabbing, and that adds another momentum for volatility. Now, actually, momentum is something different. I will also talk about momentum and how to find momentum in Forex market, but let's stick to volatility. Usually, after a breakout of important support or resistance levels, we can spot volatility happening in Forex market. So actually, usually when there is big news on let's say cable GBP, we can spot a good volatility on GBP, USD, GBP, Swissy, GBP, or the GBP New Zealand. Actually, GBP crosses. And that is the thing when we should set up our charts to trade that particular pair. So guys, remember, if you want to be successful in your trading career, you need to trade more than one pair. You cannot stick just to trading majors. I mean, maybe there is some of you who are actually are successful in trading only 3 or 4 pairs. But being a trader for 6 full years, I know what should be done in order to make money. So actually, when I switched from, if you followed my posts on Euro Dollar Trade back in time and Spiders then back in time on Forex Factory, you probably remember the time when I was trading mostly Euro Dollar, and when I was doing mostly Euro Dollar analysis. That that was basically when I traded majors, and most of the time I was trading Euro Dollar. But since the inception of complete price action method, which I created, I told you Camarilla MACD, I actually switched to trade 25 different pairs. And Euro Dollar is, I can say that is one of pairs which I don't trade so much. I actually like to trade pairs which give me the chance to trade. So guys, if I spot volatility in GBP crosses, I will trade GBP crosses. If I spot volatility in OD crosses, I will trade OD crosses. If I spot Euro, no problem. Euro crosses are the option. But the thing is, usually there is volatility in, not in all markets, just in some markets. Let's say GBP dollar is moving, GBP Swissy will move, GBP Aussie will move, but Aussie, that is Australian dollar, dollar cross, it will maybe be a bit slow. And Swiss yen also will be a bit slow. So first of all, the thing is, if we spot a nice big volatility, we can wait for retracement to actually trade it. Because a bigger volatility can be also a sign of a new trend or a trend continuation. So that is a good thing. Volatility is magnified by the use of leverage. So if you plan on using leverage, and if most of retail traders want to use leverage, that will mean that volatility will surely be magnified. Also, as I said, contrary to stock market, currency trading brings a high degree of volatility. And minor crosses usually will give you a higher degree of volatility compared to standard major pairs. So what are the causes of volatility? Every day's high impact news. You probably know, if you follow, also you can follow that on Forex Trading. You know that there are exclamation marks on calendar, and when you see 3 exclamation marks, actually that will mean that there is high impact news coming, and that will probably cause some volatility in market, unless the markets have already been involved in high volatility prior to high impact news. Rumors also will cause volatility in forex market. Let's say that an important person from ECB will talk, that probably if he speaks something which has not been planned and which most of the people recognize as a rumor, that can create huge fluctuations in near-term sentiment. So actually what can happen is you have witnessed a nice uptrend, zigzag, and suddenly the price is dropping like a rock. That could be caused by a rumor. So you actually need to pay attention what was the cause for that particular market behavior. Then geopolitical events. If you remember a crisis in Ukraine, in Crimea, there was a huge volatility in dollar ruble pair, and actually people and traders who had the access to dollar ruble forex pair could have made a lot of money just by exploiting geopolitical event which happened in Crimea. There are also macroeconomical news. If you know, there are globally recognized news which usually happen during our standard day of trading. And you need to pay attention when those news happen, and you need to pay attention when it will happen, just because they can spike your stop loss and then continue in desired direction. Usually that means, let's say that you have been trading cable pair pound dollar, and actually you enter here on this price, and now you're in profit, but there is impending GBP dollar news coming. What can happen is, and let's say that stop loss is here, what can happen is actually the news is kicking in, the price is going through break even, and then it hits your stop loss and it continues further up. Guys, there is when you need to understand the news and when to understand the trend. And that is actually why I will be showing you how to trade in that circumstance. That way you will be probably most of the time right if you apply the method which I will show you after next few slides. Natural disasters are also a problem for volatility, high volatility. And if you remember earthquake in Japan a couple of years ago, I know that many traders actually lost the money just because they were trying to trade during and just after the earthquake in Japan. Central bank interventions also can cause a high volatility in Forex market. Actually, those central bank interventions can be very dangerous, but actually there is a cure for that, because if we follow the price and if we spot that the price is very close to historically important low or historically important high, actually we just need to follow the price to see if there can be a sign of intervention. And that way, if we are following the price completely, we can protect ourselves. Profit taking is also one of reasons for high volatility, because profit taking can actually be a first sign of a reverse. So let's say that the price is going upward, and when profit taking occurs, usually the price will start a retracement. But you need to figure out whether that is a retracement or a reversal, because retracement and reversal are not the same things. Now, what are the advantages of volatility? As I already said, in order to make money, volatility should be present. Volatility will give boost to our entry, turning it into a profit soon. So usually you probably know that you have made an entry, let's say here, and the price is going sideways, it's going up, down, and there is a first surge of volatility that will push the price, usually, if we are right about our entry, in a nice profit. Especially if you're trading minor crosses, such as I do, they can really make a difference. Let's say that if GBP dollar is making 15 pips, GBP Swissy or GBP Ori same time can make 30, 50 pips. So actually that kind of volatility is what we need to make nice profits in Forex market. But remember, you still need your risk to be low. My usual risk when I trade is 0.5 in a single trade. So actually my full risk is 2%, let's say completely. So if I make 4 different entries, my full risk is 2%. And actually those who have seen my real account know that my actual drawdown is very small. And last 6 months, I made something around 17%. I also showed that to on my last webinar, and it was something around 17% trading every single pair. So volatility can be your friend if you know what to do. If you're a scalper, then you can exploit fast scalping trades during the period of volatility. If you want to make a scalp swing, that is actually my term for a bigger scalp, you need volatility to make a scalp swing. So actually, instead of making 5 pips, if you know how to scalp swing, you can make 15 pips. I will also show you in one of our upcoming webinars how to turn scalp into scalp swings. Then we have intraday direct rise or direct fall. Actually, that can be a good thing if you are already in the price. So let's say that you're in the trade and in the price, and there is actually a direct rise. This is direct rise, and this is direct fall. So if the price is actually making higher highs without any sign of retracement, that is a direct rise. Direct fall is contrary to direct rise. If the price is making lower lows or a single low without making a retracement, it's called direct fall. And the actual causes for direct rise and direct fall is volatility. Momentum trades. If you know how to exploit momentum, then volatility will again be friend to you. If you want to reverse positions from going long to short, you can also do that if there is the volatility. And of course, I don't need to mention that breakout trading. Breakout trading is very important for actually making a volatility trade. Let's say we have a flat top ascending triangle and we actually are looking for a long trade. On the surge of volatility, we can go for a breakout, pullback, continuation trade. Now there is a question from Mr. C to all participants. Probably, where can we short Aussie today? Mr. C, I need to tell you, actually, I stopped trading yesterday, and I'm basically, I will be on holiday just after I finish with this webinar. So I didn't make any analysis in this week, and you need to wait for my analysis after I finish with my holiday, and that will be on 18th of August. So actually, I didn't pay any attention to market today because actually this is this is the time when I actually want to relax. But yeah, after I will show you volatility trading. So actually I will open the Aussie chart and I will maybe use volatility trading example for that. So let me continue. So momentum trades, reverse positions, and breakout trading, very important if you want to make a breakout trade. And now disadvantages of volatility are over trading. You should never ever do that. Revenge trading, which is actually revenge trading is actually one of the biggest nemesis of a Forex trader. Over trading is when you actually do more trading than you should. And revenge trading is actually when you're making up for losses by doubling your trade and doubling your volume traded. Revenge trading, if you, let's say that you have 0.3 trade ongoing, price hits your stop loss, and what happens is you immediately open 0.6 position, and that is called revenge, because you're actually taking a revenge to market because you lost position. That you should never ever do that, because that will lead to gambling, and gambling is not professional Forex trading. There is no bigger nonsense than if someone says to you that Forex is gambling. That is not gambling, and whoever wants to talk about gambling, go send him to go to casino and not to Forex market. Swing traders suffer from huge volatility because today swing trading is it can be very dangerous to go for a swing trade because there are very big fluctuations in Forex market, and actually for a swing trade to be successful, market should be in a perfect harmony, and today that is not the case. Whipsaws on every time frame. If you see that the price is doing it like this, that can cause whipsaws on every single time frame. Non-tradable environment on very huge volatility, and traders who don't trade 20 or more pairs may suffer a lot. I already talked about it, and now I will show you how to actually go with volatility trade. This is how I do it. So actually, I am not sure that you already know about it, but this is how I do, and this is how I teach people to trade on volatility. My style of trading is to do it only on 1 hour chart, so exclusively 1 hour chart. Then you should look up for Marubozu candlestick, draw Fibonacci in candle direction. I will also show you on real-time chart just after I finish with slides. Entry should be always around 61.8 or 78.6. Marubozu candlestick should at least 25 pips in itself, and it usually happens after a breakout of important support and resistance level. So this is the trading rules in the core in itself. These are, I need to show you a Marubozu candlestick because volatility trading is done on Marubozu candlesticks exclusively. You don't look for any other candlestick pattern. So bullish white Marubozu candles are these candles. So white closing Marubozu, white opening Marubozu, and white Marubozu. White closing Marubozu it's very easy to differ because closing Marubozu has a wick just below the body, a small wick above the body is white opening Marubozu, and white Marubozu, clear Marubozu, is a candle which does not have any wicks at all. So open 1 hour time frame chart, so 1 hour time frame chart, look for Marubozu candlestick. Draw Fibonacci in candle direction. You always draw Fibonacci from left to right. You never ever draw Fibonacci from right to left. That is not how Fibonacci should be traded. So always from left to right. Entry should be around 61.8 and 78.6. So those two levels are actually entries. At least 25 pips in Marubozu, and usually it will happen when we have a huge momentum. Now, black Marubozu candlesticks. This is black Marubozu, closing Marubozu, and opening Marubozu. And this is how it's done. So we see, let's say, you can trade on every single pair. So actually there is no, because this is price action. Price action can be traded on all Forex pairs. And I always prefer to trade pairs which don't have more than 3 pips spread. And actually, I have institutional liquidity with my account, so my spreads are always tight. And actually, on platform which I trade, the spreads are really good. So, Aussie example, we have a Marubozu candlestick. This is Marubozu candlestick, a huge momentum bully candle. And after the candle has been printed out, we try to go for a retracement entry. So very simple, guys. Rules are really simple. You need actually to wait for a retrace to 61.8 and 78.6. And then the price usually will hit your entry and proceed further. This is also another example of a volatility trade. The price has made a huge breakout to the upside, and this was an important level of support, and huge breakout, and then basically it came a retest, but look at the level, 61.8, and bang, the price went down. Bang, the price went down. Bang, the price went down. So actually 3 successful trades in a row just by trading high volatility candlesticks. New Zealand dollar, again, big, huge momentum candle on this pair, and you just wait for a retracement to happen, and look at this, 61.8, 78.6. The price has hit again those levels, and then bang, it went down. Now, usual question is where the stop loss is. Stop loss is always above momentum candle, candle, high or low. So actually, when you see that the candle is making a huge breakout of important support resistance level and Marubozu candlestick, you need to have 25 pips in it, and then you just draw from the top, in this case, to the bottom, and you can see retracement to 61.8 and 78.6, and price actually hitting the levels and making it almost target is usually next important support or resistance level. I actually have pivot points on my chart using Camarilla, and I also draw manually those important support and resistance levels, and I extensively use trailing stops. So most of the time you will be correct with your entries, but then you need to go to trade management and manage your trade. Now I will show you that on a real-time chart. So actually you will see, okay, this is an example. Let's open Aussie. And Aussie is in a downtrend. We can see that. And this was actually the point where we could sold Aussie. This is very clear, those weeks. But let's stick to presentation. Actually, this is Marubozu candlestick. Okay? This is Marubozu candlestick. And usually you need to pay attention to trend. This candle that happened in Asia trading session, and I'm not particularly trading Asia session, and you can see that historically the price was very high. And then this is very clear. The price has broken through the support, previous support, and made a Marubozu candlestick. Now, the pip count in this candlestick was actually from high to low, it's 26 pips. So this can be an example of nice volatility. This is volatility candlestick, Marubozu, and we actually need to just draw Fibonacci. And guys, you need to know how to draw proper Fibonacci levels. Always from left to right, okay? And always on that same candle. You're not interested particularly in drawing the Fibonacci to next candle. So always for that same candle. And just guess where the price stopped. 61.8, previous support, now acting as resistance, and bang, it went down. And normally, my first target for this trade would be something around this region. And this is, if you know what volatility is, you know this is very simple. And now, you won't always get the price in your direction. Initially, the price may fluctuate a bit, okay? It may fluctuate a bit. Let's see in this example, the price has never touched the stop loss, but you see, actually it made a nice thrust, and then bang, it went to the upside. Sometimes you will miss the entry because 61.8 and 78.6 are actually the best numbers, in my opinion, for trading quality retracements. And quality retracements are needed if you want to keep your risk low and to get the best possible entry on the price. So actually you need to wait for 61.8, 78.6 to hit, and then trade it. No, on higher time frames, I don't do it. Boyke is asking, can it work on higher time frames? You can try. I never tried on 4-hour daily and lower because my primary intraday time frame of choice is 1 hour. So actually, this is how I do it. If you want, lower time frames are more susceptible to violent movements. So I wouldn't recommend you trading on lower than 1 hour. And on higher time frames, if you want to test it, go ahead. So far, the only thing I have been trading is 1 hour, and that works for me. So, I don't need anything to change as long as it works. So actually, it works. And that is what I would suggest you. Now, these weeks are not very welcome when you trade high volatility trading. Actually, we need to see nice Marubozu candlesticks. This is Marubozu candlestick, but obviously the price didn't make the 61.8 retracement. Also, this candle, and usually, this is important. Usually, I want to see retracement in next 3 or 4 candles. So after the price has made Marubozu volatility candlestick, I want to see retracement to 61.8 and 78.6 during next 3 hours. So 1, 2, 3, eventually the 4th hour, because that is contained within 4-hour trading also. And actually, you will be still trading with that volatility if you trade in next 3 or 4 hours. But usually the entry will come in very, very soon. This can be volatility trading, and this is a sort of volatility trading, but actually, in this example, stops should have been a bit higher. But that is, again, a risk which you need to be presented because you will be trading with higher volatility. And actually, 61.8 and 78.6 were good for entries, and but you see here the price has just went a little bit above it. So actually I will see. The stop loss wouldn't been hit here, but on this example, it would be hit. So actually you always need to watch the stop loss is contained within your risk limits. So you can widen your stop loss, guys, but only if your risk stays the same. I usually trade with 30 pip, 35 pip maximum stop loss, and my risk is 0.5. If I traded with a 50 pip stop loss, again, my risk would be 0.5. So you need to incorporate, because you will be trading according to your stop loss. You won't be trading according to your target price. You're always trading according to your stop loss. So if you're making a risk of 30 pips, it should be the same, 0.3, 0.5. If you're making risk of 50 pips, it should be again the same, 0.3, 0.5. Again, a good example of trading and successfully, this is a successful trading of volatility candlestick. Again, look at this, 61.8 and 78.6 bang. The price went down. So actually, the thing is, you will be trading also within the trend if you're trading with a high volatility trading. So rules are pretty simple. This kind of trading has been fruitful for me. So if you have any further questions considering high volatility trading, you can ask me, and I will gladly respond. So again, a nice example in uptrend. You can find many of those examples, and that this is also one of the examples here. You can see a nice candle here, volatility candle, price making it to 61.8 and 78.6, and you can see how the price is reacting. Again, uptrend, break of important resistance. So this was important resistance, and this was also important resistance. You always need to know what you're trading. So this is important resistance. Both of those resistance were broken. The price hit 61.8, and actually it proceeded in trend direction. And that is the thing which you should try to incorporate in your trading. Now the thing is, we need to finish with the webinar, and I will try to respond as fast as I can. When do you enter? Do you wait for the candle that touches? Yes, I never trade candle close. I always trade price action. So actually, I'm waiting for the price to touch 61.8 or 78.6, and then I place the trade. I just do not trade candle closes, because if you trade candle close, you don't trade price action. You're trading a limited price action. That is another story. So limited price action is actually when you are trading candle close, top of the hour, it's called TOTH. So the thing is, if you go with price action trading, you're actually trading the price. So actually in this example, we can see that in this particular moment, the price was this. And I actually will trade from this point or from this point, because this is the price, not candlestick. Okay, thank you guys for participation. Now I don't have any time. Unfortunately, I come from Serbia. I live in Serbia, and actually that is where I come from, if anyone is interested in. And the thing is, if you want to ask me anything about this, you can write to my email. I will again respond. Thank you for participating. I will talk to you soon. If you go on holidays, cheers, and I wish you all many green pips. Thank you, and see you very, very soon. Bye.